Good morning, everybody. Hopefully, you had a wonderful weekend. We'll go ahead and get started here. So, 5-minute money maker last week was the demographic with the highest divorce rate is now age 50 plus. So we gave you some resources you could use with your divorcee clients in case you run across that. So, 5Q tape breakdown, get a great little lesson on how to communicate with clients about numbers and math. This is important because we try to avoid numbers as much as possible, but we do have to cover some numbers. So how do we do that? This little tape will tell you how to do that. So please, if you haven't looked at that, go look at that. So there was a little experiment that was done, and they used weather forecasters as an example of this. So two predictions for temperature. Let's say we have one forecast A and forecast B. Forecast A is the temperature is going to be 55 to 75 degrees tomorrow, and forecast B is going to be between 64 and 66 degrees. And the actual temperature is 68 degrees. So which is more accurate? Let me see you guys answer that. Which is more accurate? I got a few in there. Looks like we're about split. Yeah, we're about split. So we think that this is more accurate because that fell within this range. Look at how small this is, and it was only a few degrees outside of this range. So you could argue either way. The answer to this is a trick question because answer A or forecast A or forecast B, you could argue A is more accurate because it fell within the range. You could argue B is more accurate because they were only 2 degrees off from what they predicted. So the real lesson is not which one is more accurate, but which one is perceived to be more accurate. So more people would perceive A, and that's exactly what happened. More people would perceive A to be more accurate. So what do you think the lesson is here? What do you think the lesson is here then? When we make predictions, we should make use broad statements, broad ranges, Nick and Till. That's exactly right. Make broad predictions and broad within broad ranges. So now, how do we do that with our equity side? What's the promise? We make 3 promises with our equity side. What are the 3 promises we make? Specific or very broad? Very broad, right? Very broad. Yep, Ron. So we say, if the market goes up, your count's going to go up. If the market goes down, your count's going to go down. And historically, the markets have gone up more than down. So these are broad statements. So how accurate are we going to be perceived by our clients? So everybody answer that. How accurate will we be perceived by our clients of these 3 statements? Come on, everybody. 100%. So we want to make sure when we're talking about our money managers, don't start talking about things like, well, he's not going to give you all the upside, but he's going to protect you on the downside. Is that becoming more specific when you say something like that? Is that becoming more specific when you say, yeah, don't do that, don't do that, don't do that? That's becoming more specific because now, you know what? Could a manager who says, I'm not going to, maybe won't get all the upside, but I'm going to protect you on the downside. Is that any type of guarantee, guys? Could a manager say that they're not going to give you all the upside, but they're going to, but you'll avoid all the downside? Could that go bonkers on them? Could it actually give you more of the upside? Could it actually? Yeah, it is an implied guarantee, an implied guarantee, and we don't want to do that because we can't give that guarantee. And that's measurable. That's measurable. When you start to give them, we won't give you all the upside, but we'll protect you on the downside. That becomes measurable because if you're down below what the downside is, you're going to be in big trouble. And then how are they going to measure not all the upside or not all the downside? Within 1 or 2 degrees or within 15 or 20 degrees? Yeah, we don't know. So keep your statements broad, and you'll be considered more of a genius. Okay. So this book, Laws of Wealth, Psychology and the Secret of Investing Success by Daniel Crosby. So wouldn't it be great if we could read one book and have all the knowledge of the Encyclopedia Britannica, for those of you old enough to remember the Encyclopedia Britannica? Wouldn't it be nice if we could just take one trip and have experience all the things that the world can give us? Wouldn't it be nice if we could just do one push-up and become ultimately fit? Is that the way the world works? Is that the way the world works? No. We have to constantly work at things, right? Work. It's like the 15-minute drill. If you stop doing your 15-minute drill, what's going to happen? Your skills are going to start to degrade. So it's this constant work. You got to adjust. And I'm a huge fan of working and adjusting. You know, we have this attitude, don't just stand there, make something happen, right? That's Lee Iacocca. So we're of the opinion that's a good thing or a bad thing in our lives, especially in our work lives. Good thing or a bad thing? Make something happen. Yeah, we're of the opinion it's a good thing. So sometimes is there any such thing as a perfect answer, though? There might be an answer that's good most of the time, but not good some of the time. And I'm going to go through today where taking action is not necessarily a good thing. First, we're going to look at real life. So soccer penalty kicks, where one guy is going to line up against the goalie. So what should the goalie do? Should he move before the guy, after the guy? Wait, what do you think the goalie should do? What ends up, 94% of the time, they're going to dive left or dive right, because that ball is coming in very quickly. Kicks that went right and left of center, 33% each. So when they analyzed all the kicks in World Cup soccer or what do they call it? What's the league? The highest league in Europe and South America. They analyzed all the penalty kicks and they found that about a third of them went right. Premier, thank you, Tom. The Premier League. A third of them went right, a third of them went left, and a third of them went center. But what did the goalie do? They dove left or right 94% of the time, which means that 2/3 of the time they're going to be right. Wrong. So goalies that stand in the center stop the ball twice as often. Goalies that just stay right in the center, they're going to stop the ball twice as often. So how many goalies do that, did we say? How many goalies stand right in the middle? Only 6%. So why? Why do they, this is a known fact. So why do goalies then, even though if they stood in the middle, they'd stop twice as often, why do they go ahead and dive left or right? Is that a little bit wrong or a lot wrong, guys? Mark, you got it. They think they're smart. They think they're in control of the world. Those statistics belong to who? Those statistics apply to who? These statistics of losers, other people, not them. You know, the other thing that happens is if they stand in the center and the ball goes left or right, you know, how are they going to be perceived? How are they going to be perceived by the fans? Slow, caught flat-footed, doing nothing. See, so they have to what? They have to take some sort of action, because if they don't, especially in the Premier League, like in England, guess what's going to happen? A riot. So even if they knew that they should stay in the center, they stop twice as many balls, they'll still take action, because if they don't, it's going to be perceived as if they're not doing anything. Does that make sense? So what do money managers feel the need to do? When things aren't going right, or even when they're going right, what do they feel the need to do? Yeah, trade, to do something. You know, they pull out their pencil and paper or their computer programs, and what do they do? They're going to calculate, and what should we do? Well, how can we eke out more returns? Oh, the market's going down. What can we do to prevent the downside? They always feel like they must do something. Now, there is one famous investor who is totally anti that, and who's that? Who's the famous investor who's totally anti-doing something? Liliana's got it. Nick's got it. Everybody's getting it. Buffett, he says you buy it and you plan on holding it for at least 10 years, right? But is that how most money managers work? No. Because, again, they believe that what? Though all the statistics that say hold on belong to who? Somebody else, because I'm smart. I know what I'm doing. My algorithm works. See, and it's natural. We believe that activity equals results. And does that, I said 15-minute drill every day. Activity equals results. You do a 15-minute drill every day, you're going to get results. You practice the scripts on a weekly basis, you're going to get results. If you do the work, you're going to get results. That's how we were brought up. And does that work 99% of the time? Working equals results. That works 99% of the time. People who don't work get what kind of results? People that don't put in the work, people that have no activity, people that aren't, it's not going to work. But this is one situation where it does work when it comes to investing. You should don't just do something, stay in there. That's what you want to do when it comes to investing. You want to manage money better by using mindfulness, staying in the moment. It's hard to do though. Do you know what's going to happen 10 minutes from now? Do you have a pretty good clue of what's going to happen 10 minutes from now? Everybody answer that. Do you have, if you think about it, do you have some semblance of what's going to be? You're probably going to be sitting there at the computer listening to me 10 minutes from now. You're going to be drinking coffee. So you have a pretty good clue what's going to happen 10 minutes from now. How about 10 days from now? What happens to that certainty? Goes down. What happens 10 weeks from now? What happens 10 years from now? That certainty continues to do what? Fade. But there is one situation where that is completely reversed. Any idea of in what thing in our lives that would be completely reversed? That the longer we look out, the more certain we are to know what happens. Who said that? Till's got it. Mark's got it. Graham's got it. Yeah, when it comes to investing. When it comes to investing, that's completely opposite. What's our feeling that the market's going to be up 10 years from now? Most of us believe that what? Pretty good chance. Now, it's not always the case, but we got a pretty good chance it's going to be up 10 years from now. Do we have any clue what the market's going to do 10 minutes from now? No. See, with everything in life, we have a better idea what's going to happen 10 minutes from now, and the further it goes out, the less clear that becomes. But with investing, it's just the reverse. The longer you wait, the more certain it becomes. I don't know what's going to happen 10 minutes from now, 10 days from now, 10 weeks from now. 10 years from now, I'm pretty clear that the market's going to have moved up, or we better be buying beans and ammunition, right? So when we look at the range of returns on stocks from 1926 to 1997, 1 year, it ranged, the best return for 1 year was 53%, the worst was minus 43%. 5-year periods, the best 5-year was an average of 23.9, or an average of negative 12.5. 10 years, 20.1, negative 1%. 15 years, an average of 18%. Just making 0.5% a year. You understand these are averages, right? Your annual averages. 20 years, 16.9% average, or 3.1% average. So the further we go out, the more certain we are going to be making what? Money. But so what happens at these ranges? Looking just 1 year out, how huge is this range? It's almost 100% difference, right? What's happened to the range by the time we're 25 years out? Goes from 100, a difference of 100% to what? Difference of about 10%. So it's a tenfold. We have a tenfold higher certainty 25 years out than we do 1 year out. So should we be trying to predict when we should be in and out of the market? Should we be trying to predict when we're out of the market? No. Should we try to time the market? No. It says that only buy something that you'd be perfectly happy to hold if the market shut down for 10 years. That's the way we should be looking. Now, so if you're trying to tell people that you have an algorithm, your manager has an algorithm, you've got it figured out, guess what? How do we know that's not the case? What would be your manager's minimum client size if they really had it figured out? So those of you who are training, you heard me talk about this last week. But we do cover these things about once every 6 months just to make sure people remember. Yeah, so I'm seeing, like 100 million to be their minimum. That's exactly right, if they really had it figured out. So in the 1950s, people, or the average stock, not people, that's people, investors, individual investors, and institutional investors included. In the 1950s, average stock was held for 6 years. Want to guess how long the average stock is held today? Yep, Liliana, 6 months. That's it. So that's a 10-fold or 12-fold increase in how often stocks are traded. See, unfortunately, what's happened is, do we have a lot of data now available to us? How much data do we have available to us? Even the investor at home probably has more data than a professional investor had in the 1990s. So we've got how much data? As much as you possibly want. And then we have intuition that tells us that it's easier to know today than tomorrow. See, it's easier to know what's happening today than tomorrow. But we just went through that. When it comes to the market, do we have any clue? The less time that the shorter time period we look at, the more we know what's going to happen, or the less we know what's going to happen. The shorter the period. Do we know what's going to happen 10 minutes from now in the market? Do we know what's going to happen a day from now in the market? Do we know what's going to happen a week from today in the market? We know what's going to happen 10 years, but we don't know what's going to happen tomorrow. But again, how often do you hear about some guy in his basement who's called a decade trader? You ever hear about those decade traders? No. What do you hear about? All these geniuses in their basement. What are they called? Decade traders? What are they called? Day traders. That's right, Susan. Day traders. So because what? They think that they can what? Predict the future. I'm looking at the technical side. I'm looking at the subjective side. No, the fact is that it's very, very difficult to make money when you start to bet on daily, or even some of those day traders doing it on by minute basis. And we think that that's going to give us better decisions, but it does not give us better decisions. And how do most guys test their money managers or even day traders? How do they test to make sure that they have a good system? How do they test to make sure they have a good system? Historical results or back testing, right? And what does the science say about back testing? What does science say about back testing? It's bunk. Yeah, so this is from the Institutional Investor. It says about 2/3 of smart beta track records are backward-looking, frictionless results that can bias investors' live return expectations higher than may be realistic. We're talking about institutional investors, so we're talking about the institutional investor, not the guy on the street. These are people that should know better. They're trained. They have experience, and they are still biased when it comes to back testing. While back testing may be useful for gaining a better understanding of risks tied to an investment strategy, there is a reason to be cautious. The results can be influenced by data mining and tend to ignore transaction costs and other fees. Guys, if you ever looked at the Forex, there's tons of systems out there that work fantastic for the Forex, but what kills them? What kills them? The spread. You add the spread in, guess what happens to all those systems? Yeah, the trading fees. When they collapse. So we can't rely on back testing. And what have they found? Has any money manager, I shouldn't say has any, how many money managers and hedge fund managers have been busted in the last 5 years because what they were showing clients was actually not a real portfolio, but actually a back-tested portfolio that did not have real life results. They were just simply using going back and cherry picking a methodology that worked over the last 5 years. I can think of 5 of them right off the top of my head. And guys, how many of you have actually worked with a money manager and you're looking at the results that they're posting are not what your clients got? I see that all the time. And are your clients getting higher than what's posted or lower than what's posted? Lower. That happens all the time. Backtesting, the chief investment officer. Again, are these doughheads? Investment and institutional investor, and the chief investment officer, are these doughheads, or these are supposed to be the guys that are trained better than anybody else out there? And that's what the resource is saying. Managers who cherry pick for optimal results aren't even the worst abusers, argues Guggenheim's top quant. Most back tests published in financial journals are wrong. Most back tests published in financial journals are wrong, a quantitative research specialist from Guggenheim Partners argued. The tool is popular with financial academics, but as it is misused. According to Marcos Lopez de Prado, a senior managing director, which may invalidate a large portion of the work done over the past 70 years. So he's basically saying all that data out there about what works and doesn't work is what? So Lopez de Prado holds 2 doctorates in the subject and a research fellowship with the Lawrence Berkeley National Laboratory. That's a rocket science laboratory, guys. Has been sounding the alarm at pseudo-mathematics and backtesting for several years. Backtesting is bogus. Well, then guess what? If backtesting doesn't work, the only other thing that can work is what? Seeing the future. So if backtesting doesn't work, the only other thing we do is see the future. And how many people can see the future? So all we can do when it comes to managing money is what? Make 3 promises. If the market's going to go up, your account's going to go up. If the market goes down, your account's going to go down. And historically, markets have gone up more than down. Make sense? And we see that when we look at how often the index beats just any money managers out there. So all cap funds over the last 15 years, 92% lost to the index. Mid cap, 95% lost. Small cap, 96% lost to the index. So it's very, very difficult. Now, what about these folks, though? Did some people beat the market, guys? Did some people beat the market? Some money managers. They certainly did, didn't they? They certainly did. So let's say we looked at 1,000 of them, and after and we had 8.9% of them beat the market. 8.9% beat the market. Those guys are going to be what? So the top 1/6 of them beat the market. So those guys have got it figured out. Yeah, they're rock stars, right? So they're rock stars, but are they rock stars because they've got it figured out? Is that why they're rock stars? Well, Graham's got it. Susan's got it. Yeah, Nick's got it. Here's why. This graph right here isn't money managers. See if anybody can guess what this graph is. There's 6 categories here. Is there anything that has 6 things in it? This is actually using a revolver to play Russian roulette 1,000 times. At the end of the 1,000 times, guess how many people, or at the end of just 6 times, guess how many people are still left? 89. So are they awesome Russian roulette players, or were they lucky? They're lucky. They're lucky. They didn't have it figured out. They didn't think that, well, if you tap it twice on the counter and blow on it, the bullet won't, you won't end up with the bullet in the chamber. They didn't. No, that's how it works. So after 6 times, 1,000 people, 8.9% of people are still playing. How close is that to how many money managers are still playing after 10 years? And how many? I mean, it's almost identical, right? What's going to happen as they play Russian roulette to the 7th time and the 8th time? What's going to happen? What happens to the lucky people? What to the number of lucky people? Continues to what? Crash. So, smart or skillful? Henry Blodgett's detailed disclosure statement here to read previous. It's that time of year again. Wall Street strategists are updating predictions of the current year, offering them for the next. They're analyzing interest rates, valuations, profits, economics, geopolitical, blah, 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 all that stuff that they throw at you, telling you that, hey, I know all these things, and I've calculated all these things, and I've ranked all these things, so that's how I can use my technical and quantitative metrics and dozens of other factors, and I can tell you what's going to happen. And as usual, guess what most of the strategists are predicting for the market? What are most strategists predicting for the market? Up and up and up. And there's been study after study after study have done this. How many years have the majority of strategists predicted, how many years out of the last 100 has the majority of strategists predicted the market was going to go down out of the last 100 years? Zero. Not few, not five. Zero. And if you think about it, why? Why is that the case? If strategists are predicting the market's going to go down, what just happened to the profit margin of all the trading companies? They won't be able to sell investments, Ben, right? So guess what's going to happen? So now this is understandable because the market usually does go up. It's not for the exact reasons that strategists predict. Well, then it's just because it usually goes up. From 1872 to 2003, according to data compiled by Yale's Robert Shiller, the S&P 500 rose 83 of 132 years, 63%. So guess what? It goes up 2/3 of the time, goes down 1/3 of the time. Strategists who predicted the market would rise every year, in other words, regardless of logic used, would have been right nearly 2/3 of the time. So what's another reason why strategists constantly say the market's going to go up and up and up? Because they're going to be right what? 2/3 of the time. That's why. In the investing business, you can make a lot of money and acquire a solid reputation if you're right 2/3 of the time. But this is why market forecasting is different from, say, astrology or tarot card reading. In the markets, the future is not limited, it is binary. Stocks and markets can either go up or they can go down. And this, in turn, is why thousands of professionals and millions of amateurs who are perceived as having forecasting skill may, in fact, have no more ability than a Halloween party swami with a gag store turban and a crystal ball. Because stocks and markets can only go up and down, analysts and strategists and investors often have a 50-50 odds of being right. Here's the catch, though. Human psychology being what it is, stock forecasters and those who evaluate them also never factor these odds into their assessments of the forecaster's skills. They never add these 50-50 odds into the skills. And here's what they mean by that. This phenomenon of mistaking investment luck for skill infects every inch of the investment business, from investment banks to mutual funds to financial media and individual investors. It is also probably responsible for more losses and bankruptcies than any other market force from dawn of time. You know, for example, long-term capital management killed the market for about 5 years before it what? Blew the market up. Because they were looked at as skilled or lucky. What were they looked at? Rolls and shoals, they were looked at as what? Skilled. And then up, they were what? Not so skilled. So no matter how carefully or often the concept is explained, no matter how much evidence is provided to back it up, most people just can't accept that their investing probably has more to do with luck than skill. Well, maybe other people has, more to do with luck. But I've got this algorithm. I've got this experience. I've got this blah, blah, blah. Maybe other people's is luck, but not mine. No way. But they forget for a moment, all the factors that influence stock prices. Imagine instead that the market is a coin. And again, the market can do what, guys? Can go up, can go down. And guess what? When you flip a coin, it could be heads, could be tails. So if you assembled 1,000 people and you tell them that to assess their powers of prediction, you're going to flip a coin. And when they protest, say, well, coin flipping is just unpredictable. You don't know how to. I mean, you know what? There is no skill to flipping coins. Forget it. There's no way that there's any system to help you predict what's going to happen with coin flipping. I mean, isn't that what most people would say? There's no way you could do that. But if you convince them that, well, watch, there actually is. And you get them to at least do it, and you say that to some of them, that those whose powers of perception will allow them to spot patterns in behavior others can't see. So there are people that actually have this ESP where they will be able, not many people, but some people do have this ability to spot patterns in behavior on how people flip the coins, whether they're left-handed or right-handed, whether it's what year the coin is. They'll be able to predict flips with greater than average frequency. So approximately 500 people the first time they flip, 500 people are going to call heads and 500 people call tails or something like that, right? So they flip the coin. Now, when the coin lands, post the names of the winners on a gigantic scoreboard. Call for a new round of predictions, because after one, they know that what? For the 500 people that called it right, they were skilled or lucky. What are most people going to think at that point? After one flip, yeah, just lucky. But now after 5 flips, the scoreboard should display the names of about 30 people who have been right 5 times in a row, along with hundreds of others who have been right 2 or 3 times, or 2/3 of the time. If you were to conduct interviews, you'd probably find people starting to believe that maybe those people on the scoreboard were better than average flip predictors. Now you flip some more. After 8 flips, you should have 4 people with a perfect record left. After 9, 2. After 10 flips, 1. One person whose powers of prediction are apparently so acute that he or she has correctly called the coin an astonishing 10 times in a row. Assuming this person's success has been noticed after 4 flips, 5 flips, 6 flips, like if you're rolling the dice at the craps table and you're winning, people start to think you have a hot hand and you know what you're doing there. You can imagine the accolades he or she might now receive, because they say, wow, you got 4 flips in a row. Now they start to gather around and watch his flip. Holy cow, he got that one. And then more people gather around and they watch the next flip. 6, he did. Now they're getting all excited, right? This guy knows what he's doing, or she knows what she's doing. So, and then if the guy says, well, here's why I know what's going to happen, he starts giving all sorts of things, that this is a 1982 coin. It's actually a little bit weighted, a little bit more silver on the head side, which is why it ends up on the bottom. But I mean, he starts giving reasons why this is happening. Guess what many people start to believe? That it's luck, or that that he's got some skill. Yeah, they start to believe skill. Everyone will want to know this genius's secrets, especially the poor sod who, via the same probabilities, he's that guy that got all 10 wrong, right, out of 10. So one of them got all 10, he got them all wrong. So for every person that got them all right, one person got them all wrong. So in truth, of course, this savant isn't good. He was just lucky. From luck alone, 1 person in 1,000 should be able to correctly predict a 50-50 outcome 10 times in a row. More important, 500 of the 1,000 should be able to make the correct prediction half the time. The difference between stock market and a coin is that, unlike the coin flipping, the market seems inherently predictable. For some participants, it is at least more predictable than a coin flip. So what happens is what? We start to assign knowledge when it's actually what? Luck. Yeah. So recall, however, that like a coin flip, the potential market outcome is binary. Recall that only a tiny fraction of investors are right almost all the time. And is that right? Is only a tiny fraction of investors right all the time? Recall that to be a successful investor, you don't have to be right every time, or even most of the time. You just have to be right some of the time. And there's a lot of people out there like that. And the next time you hear a forecast predict that the market is going to go up, remind yourself that if a monkey were making this prediction, it'd usually be right. Because why would a monkey be usually right if it predicted the market was going to go up? Why would a monkey be right if he predicted the market was going to go up? Because the market goes up, 2/3 of the time, exactly right. Because the market goes up 2/3 of the time. So you're not some brilliant guy because 2/3 of the time you're right. You're not a brilliant guy because you call it 10 times out of 10. Because guess what? The more that guy, the guy that won where he Russian roulette, or the guy that won the coin flipping, the longer he plays, what's happening to his chance of it blowing up in his face. The longer he plays, the chance of it blowing up in his face, going up or going down? Goes up. Yeah. So when it comes to investing, don't just do something. Instead, just stand there, do nothing. Warren Buffett again says, the stock market is a device for transferring money from the impatient to the patient. So I've talked about this before. Fidelity and Vanguard, they both went through and they wanted to figure out what were the people, all the thousands, hundreds of thousands of investors they had, probably perhaps even millions of investors they had, what was making those few people that outpaced everybody else out there, that blew everybody else's return out of the water. They went and found that group of people, and then they interviewed them because they wanted to find out what parameters were they using, what software was they using, what were they using, technical analysis, or were they using informational analysis. So they're wondering what were these people that were doing that nobody else was doing. And I've talked about this before. What they found was what? They studied the best performing accounts of truly exceptional investors. They contacted the owners of the best performing accounts, interviewed them, hoping to find common threads to what made the investors exceptional. They found one, and you all know this. What did they find? What were they all alike in? They forgot that they even had the account. And when they forgot they didn't have that they even had the account, guess how much trading they did? 0. Vanguard found the same thing when they did it. A study of 20 other developed nations investors found the exact same thing. So it wasn't Fidelity investors, it wasn't Vanguard investors, it wasn't U.S. investors. It was all investors. The less they traded, the more they made. Terence O'Dean and Brad Barber also did a study, and they found that overconfidence and trading frequency is a bad thing. Because when they looked at it, the psychologists found that men trade more than women. Men trade more than women. And guess who makes more money when it comes to investing, men or women? Women do. Because they're smarter? No. Because they what? They don't. You know why? You know why women made more money? It's because I would say that they are smarter because they realized. If you ask a true genius what genius is, they'll say geniuses know that they don't know. Women know that they don't know, which makes them smarter. So if you don't know, you just hold on. When you trade less, they found that the portfolio for men is 94 basis points lower than the portfolio returns for women. The portfolio return for single men is 144 basis points lower than for single women. So at least it looks like married women will mute our tendency to believe that we know more than we actually know, right? Because our wives will generally tell us, you don't know as much as you think you do. So that helps us when it comes to investing, doesn't it? So when they looked at monthly turnover and annual performance of individual investors, if you have a 20% turnover in a month, what happens to your return? I'm sorry. When you have a high, I've gotten the wrong side of the graph here. When you have a high turnover, what happens to your return? When you have a low turnover, what happens to your return? So in our 21-point checklist, is it valid for us to be looking at turnover, guys? Heck yeah. So investor falls into a coma and turns into a millionaire. That's basically what you look at. Don't underestimate the value of doing nothing, of just going along, listening to all the things you can't hear and not bothering, just doing nothing. Winnie the Pooh is a brilliant investor. How do we follow this with 5Q? What kind of portfolio are we looking at with 5Q? Trying to predict the future or saying, listen, we can't predict the future. Let's make sure we have a ton of money that will go up. All of our money will go up when the market goes up, but at least half our money will not go down when the market goes down. See, we're not going to try to tell people that we're smart, that we're smarter than the market. Richard Thaler, renowned behavioral psychologist, he says 4 qualities that make decision-making difficult. We see benefits now and costs later. We see benefits now and costs later. So we see the benefit of what? If you ever talk to a day trader, are they ever looking at the downside, or are they constantly looking at what they could make? What they can make. I'll deal with the cost later. A gambler, they're always looking at how much they can make. They don't look at how much they can lose. They look at how much they can make, the potential. The second thing is the decision is made infrequently. Feedback is not immediate, and the language is not clear. Guess what all these add up to? Investing. These are all things that happen in investing. We don't make the decision to as frequently as we should to become an expert at that. The feedback is not immediate. When do we figure out the market we're in a bear market? Months and months. We figure out we're in a bear market after we're out of the bear market. And the language is not clear. How many different parameters can the market be measured with? A gazillion. So essentially, what do they find? And this is not just, guys, this is not just individual investors. Institutional investors do this as well. When do most people buy? How about right now? Why are people buying right now? Because they missed the what? The last 8 years, the last 10 years. Fear of missing out, right? So they're all buying when? At the very worst time. And when do they sell? At the very worst time. In fact, have you all seen the studies where they've looked at how much the market actually makes as compared to what the average investor makes? What the market makes is compared to what the average investor makes. How much did the average investor make compared to the market? The same? Yeah, about half. About half, not a little less, about half of what the market. Does that have anything to do with the investments they're in? No, it has to do with what? They buy at the wrong time and they get out at the wrong time. And is it only individual investors or is it money managers as well? Everybody. And even if the money manager is smart enough not to do it, he's forced to do it. Why? Even if the money manager doesn't want to do it, he's forced to do it. Why? Yeah, because everybody's redeeming their money, and when they want the money, they get the money. So again, we follow this with 5Q with the 50-50. Now, is it because I say you have to do a 50-50, guys? So I'm saying you better do 50-50 with your clients or you're fired. Now, why do we do 50-50? Yes, because in the investment weighting, the clients are going to tell us, and it's not 50-50. It could be 60-40, 40-60, 50-50. But we've got I don't know how many, 60,000 plus tapes. And how many times have we heard somebody wants more than 60% of their money in equities in the last 18 years? How about never? Not once out of 60,000. When you use the script, nobody's going to tell you that they want more than 60% of their money in equities. Okay? So, and why? Because when you do the FIA client presentation, guess how many people want the FIA? The biggest problem we have, and many of you have experienced it, the biggest problem you have is they want how much of their money in the FIA? All of it. We can't do that, but you're never going to find a time when they want more money in AUM than they do in FIAs. Now, let me ask you a question. A lot of guys worry about cannibalizing their AUM. Are you cannibalizing your AUM if you move the bond portion of your AUM, and maybe if you're overweight in stocks, some of the stock portfolio into FIAs? Are you cannibalizing it? No, because if you show them the FIA and they liked it, guess what? That money is gone. That money is gone. It's just that it's going to be gone to whoever shows them the FIA first. So would you rather you show them or somebody else show them? Yeah, and the second thing is, think about this. If my son comes to me and he's applied for a job and he's got the job and he's all excited, he says, Dad, they're willing to pay me one of two ways. One way is they'll pay me 7 years up front, and if they fire me, I get to keep the money. If I quit, I get to keep the money. If the company goes under, I get to keep the money. Or they'll just pay me every 2 weeks. Which way will I tell him to take? Which way will I tell him to take? Get the lump sum up front or get paid as we go? Yeah. And when we move some of that AUM money into FIAs, guess what? You're getting paid what? Up front. And guess what insurance companies do with their products over the next 7 years? Make them worse or make them better? Come up with new ways to do things. Yeah, so guess what you'll do 7 years from now? So yes, you should have AUM. So what you want to do is have some of that money coming in every single year. You know, January, I've got this much money coming in. But you should have some of your money that you get lump sum, you get paid up front for. That's what's going to allow you to grow your business. And more importantly, when the market crashes and you get hit with your AUM gets hit how much? Just when the market goes down, or even worse because people start pulling their money out? Even worse. But if you've been upfront with them that, hey, when the market goes up, we're going to make money. When the market goes down, we're going to lose money. And the market goes up more often than down. And we're going to put a big chunk of your money in this guaranteed thing so we can have patience to wait. Guess what happens to those people leaving you? Yeah, less leave. And it's less work. And remember, we talked about here about a month ago, we went through the analysis of leaving, getting out of the market 3 years early, 2 years early, 1 year early, or at the exact time. And the FIA was better how many of those times? And when we say early, I mean getting out 3 years before the market crashes, 2 years before the market crashes, 1 year before the market crashes, or right on time. Which one of those times did the FIA win? All of them. That's right, all of them. Does that make sense? So thanks for being on the call, guys. Make sure you're continue to mastering those scripts and motives. Like I said, you guys are awesome at the scripts, but you can get better. I can get better. Everybody can get better. Keep working on those. Do your 15-minute drills, practicing your GOTS. Keep paying attention to the 5-minute money makers. When you do that, you will close 100% of the people you get in front of. Tire kickers, plate lickers, people who their son is their brokers, people who love their brokers. You will move them all. So keep working that direction. I know you're all working hard. I appreciate it. And I hope you don't mind every once in a while if I just remind us and keep us sane when it comes to the market, because we're all greedy. I'm greedy, and we all have that mentality that I think I got the market figured out. I don't have it figured out. You don't have it figured out. Nobody has it figured out. And if they did, they'd have $100 million minimum client size. Make sense? Thanks, guys.